G'day guys, welcome back to the Devon Too Good Investing channel. In this video today, we're going to be doing a stock analysis on Kelly Partners Group. And Kelly Partners Group is an accounting business over here in Australia. They have an excellent track record, and in this video, we're going to be doing a deep dive into their business model. We're going to be talking about the moats that this company has. We're going to go over some of the financials. We're then going to do a deep dive into the management team to ensure that they are talented and have integrity. Then we're going to value this business to see what price is worth paying for us to get an adequate return, with of course a margin of safety. So guys, before we get into it, make sure you like this video and subscribe to my channel. Let's get right into the business overview. So who are Kelly Partners? What do they do? Well, they provide accounting and taxation services to private businesses and their owners, and the way they grow their business is by acquiring stakes in other small and medium-sized accounting firms, and of which they have a 51% interest in 29 different operating businesses, which are located throughout New South Wales and Victoria. Those are two states here in Australia, and they have a very unique sort of business model that they run, and they call it the partner owner driver model, where instead of purchasing the full business, they look to acquire a 51% stake in the business instead. And we'll get into that why later in this video. If we now focus on how large is this market, how big can Kelly Partners grow over time? Well, the answer is they can grow a hell of a lot bigger than they are right now. The total addressable market for small, medium-sized enterprises in Australia is $12.5 billion, and Kelly Partners only make up 49 million of that, or less than 0.5%, 0.4%. And over the last 15 years, Kelly Partners has had a great track record for growth. Back in 2007, all the way through to 2021, they've had an annual compound growth rate of 30%, and that's been over the course of 15 years, which is quite incredible. Kelly Partners is also a reoccurring revenue business, so 99% of their revenue is annuity revenue. So this revenue comes through consistently each year as businesses need to do their yearly accounting and taxation. And then only 1% of the business is transactional revenue. So this is non-reoccurring revenue. And if we look at the split of the revenue, 91% comes from accounting, 6% comes from wealth, 2% comes from finance. So essentially their business is very defensive, you could say, as this revenue comes in consistently each year. So if we now go and analyze the partner owner driver model, this is the model that KPG uses when they're acquiring new small and medium sized enterprise accounting businesses. And essentially, instead of purchasing the business outright and owning 100%, they instead prefer to own 51% of the business and then leave the owner with 49% ownership. And why don't they just purchase 100%? Well, if they own 51 and then the owner owns 49, it means that the partner is still incentivized to perform. And if KPG owned 100%, it means there would be no true partnership, as there is no real incentive for the owner to continue to perform well. And as the great Charlie Munger says, show me the incentive and I'll show you the outcome. And that is why KPG instead opts for the 51-49 split. And what's really important is that KPG aren't just going and acquiring any old accounting business that's cheap. They're ensuring that the businesses that they do acquire fit firmly within the Kelly Partners values, and they're ensuring that the owners of these businesses will perform and fit into these values. So I do believe that KPG has what I like to call a switching moat. So a switching moat is a competitive advantage where it is quite inconvenient or difficult to switch to a different provider. And the reason for this is KPG has a regional oligopoly, so 44% of KPG accounting firms would qualify in their own right as a top 100 accounting firm by size here in Australia. Also, to add on to this, Australia is quite a difficult place to pay taxes compared to other developed nations, and you can see that it's ranked 25 in terms of developed economies. This means that essentially people are more inclined to use tax professionals in order to submit their taxes, and that's particularly true for small business owners and medium-sized business owners here in Australia. Essentially, all these people use tax professionals, and at the end of the day, you end up making a lot more back by using a competent tax professional rather than trying to do your taxes on your own. And another reason why KPG has a switching moat is because the tax law volume growth has 14x since 1950s. So pretty much there's 14 times more different tax law to legislation to consider. And as a result, this has resulted in long-lasting relationships that last decades, and also a low customer churn rate of about 2 to 4% per year. And at the end of the day, what usually happens, and if you think about it logically, is once you have a good tax professional, unless you have a bad experience, you're probably going to keep going back to that same accounting service or that same taxation service, and you're probably going to use them year after year, particularly if you are getting good service and if they are saving you money year after year. So that's what makes this business sort of sticky. It's what makes this business reoccurring. You have to pay your taxes every year. And the facts that KPG have a low customer churn rate shows that people are quite satisfied with the service that they deliver. And what makes KPG even more spectacular is their ability to allocate capital. So over the last 5 years, they've had return on invested capital above 20%, and this is largely driven by their acquisitions. And as we discussed before, they're able to buy accounting businesses that meet and fit their values at 4 times EBITDA. And also contributing to the return on invested capital is their margin expansion. So essentially, they're able to buy these businesses that are probably run just averagely, and because KPG is an exceptional operator, they're able to increase the margins of these businesses. And then also they have organic revenue growth, and this is usually driven by population growth as well as things like inflation, where they increase the cost of their services. And if you add these two together here, you get growth rates or sort of return on invested capital plus your organic revenue growth of around 30% per year. Some years it's around 20, some years, in exceptional years, it's above 40, and then the last 3 years it's been around 30% per year. And you might be wondering, well, will this be able to continue? Will they be able to keep acquiring these businesses? And you can see that there's 10 plus firms who have owners that intend to either exit the accounting business or retire from the accounting business over the next 5 years. So there's 57% of the total firms owners who are looking to get out, and this provides opportunity for KPG to then go acquire these businesses. So as we discussed before, KPG is an excellent operator. They show signs of operational excellence, and we can see this in their gross margins. You can see that their gross margins are significantly above other competitors in their industry. They have gross margins that are very consistent, which stay just north of 60% year after year. And the same goes for their EBITDA margins. They well outperform the rest of the accounting industry. The accounting industry in general has EBITDA margins of about 19%, But Kelly Partners honestly blows us out of the water. They've got margins of 33% here. The same goes with revenue. They've been consistently growing revenues year after year since 2016. And obviously, if you think back to the first slide, they've grown revenues at a CAGR of 30% over the last 15 years. Obviously, as the business grows and gets bigger, it's going to be harder to grow at these higher growth rates. However, I think it's quite realistic that the business grows 15% moving forward, at least over the next 5 years. And as a minimum, it should grow at least 10%. And I say that with quite high confidence. You can see over the last 5 years here, steady revenue growth. And essentially, it can be choppy because you've got your organic growth and then you've got your growth from acquisitions. If KPG has a year where they decide to not make as many acquisitions, maybe there aren't many good opportunities for KPG in that particular year, where you might see slower revenue growth that year compared to a year where they go all out and make lots of acquisitions. You got to remember, this management team is very opportunistic. If they see great deals, they're going to take advantage of them. And if they don't see great deals, well, they're just going to hold cash until they see great deals that they can take advantage of. And a very key metric that I like to follow, and I respect the management team a lot for giving us owners' earnings, and this is one of my favorite metrics to use for valuing a business, as I only care about the earnings that come back to owners. And over the last 3 years, they've grown owners' earnings by 26.6% per year. Do I think they're going to keep growing at 26.6% per year moving forward? No, I don't. I think it's going to be, they're going to grow owners' earnings at a faster rate than revenue growth. However, I think 26.6% might be slightly too quick, and something in around sort of 15 to 20% over the next 5 years is probably more realistic here. In terms of balance sheet, they do carry debt because they use this debt to acquire these companies, these accounting companies, at 4 to 5 times EBITDA. And currently they have debt of $23.7 million. That's net debt. So if you look at the total cash that they have 4.8 million in cash. So essentially, they do have a bit of debt. It's nothing too crazy. It's maybe more debt than I'd like, but at the end of the day, they've got the safe business model where they've got the recurring revenues. So it's very likely that this debt is quite conservative. They shouldn't have any trouble paying this back, quite honestly, especially with the rate they're growing at the moment. So I'm not too worried about the debt. And then the company gives us a 5-year outlook, and this outlook actually only goes to financial year 24, so 2 years from now. And the company is saying they're being very conservative here, in my opinion. 15% CAGR, so they're looking at $80 million in revenue by 2024. EBITDA, $28 million with a 35% EBITDA margin. And then NPAT-A, $8 million there. I think they're going to quite easily beat these numbers, if we're being quite honest. So let's get into management here. So management is probably my favorite part of his business. I think Brett Kelly is an excellent CEO. He's an excellent capital allocator, and he is excellent towards the shareholders of his business. So Brett Kelly, he is the founder of Kelly Partners Group. He's been around since the very start, and he owns a large stake in the company. He owns 50.4% of the shares outstanding, which is just great, because if he does well, we will also do well, and if we do well, he'll also do well, vice versa. And not only that, members of the board also have some shares in the company. So total insider ownership is almost 60%. He's excellent at growing his business. It's compounded at 32% since 2006. He's had return on invested capital of 20% plus for the last 5 years. He strictly manages debt, and he only does share buybacks when the shares are below intrinsic value, which is what I love to see. A lot of CEOs don't do this. They just buy shares for the sake of buying shares, just to pump their EPS numbers, make them look better than what they really are. He doesn't do it. He's all focused on providing shareholder value here, and he isn't focused on short-term numbers. And what's really great is he treats shareholders like partners. He treats them like part owners of the business. He pays dividends monthly, which is quite unique. And his reasoning for doing this is because the owners of the businesses, those 29 partnerships that KPG has with other small and medium-sized accounting businesses, they get paid monthly. So if they get paid monthly, he believes that shareholders should also get paid monthly. So I think the management team here is truly top class. Honestly, it's kind of hard to get any better than Brett Kelly, if I'm being quite honest. But no matter how great the management is, no matter how great the business is, what we pay matters, and you never want to overpay for a business. And I've done a DCF here using owner's earnings. So essentially I put in growth rates of 15 to 19%. I think that this is around where they'll grow over the next 5 years, considering that over the last 3 years, they've had owner earnings growth of around 30% per year. I do expect this to come down, and I'm not really comfortable with putting growth rates any higher into this model. I've put in the 2021 owner's earnings. I did $5 million in owner's earnings, and I got this from their annual report. And then I've manually put in a 2022 owner's earnings numbers of 7 million. So these 2022 numbers, they weren't grown from these numbers here. I manually put them in. The reason for this is I'm pretty sure that in 2022, KPG will have owner's earnings of about 7 million. And then from there, I've grown it out at the respective growth rates. And I've put in a terminal multiple of 20. I think you could argue 15 or 20 is fine. Anything in between. It's really up to you here and your understanding of the business and how confident you want to be. If you want to be more conservative, put 15. I think 20 is okay for this level of quality. I've put in my 22% rate of return, and then the shares outstanding of 45 million shares. And what we get is a buy price of between $22.22 and $2.50. So essentially, if the shares get under $2.50, I become very interested in picking up some KPG shares. At the moment, the shares are trading at $3.90. So the stock price would have to drop, 35-40% here for me to be able to buy into this great business. I wish the shares were cheaper, as this is clearly a great business. It's a business run with great skill and integrity. There's a long runway for growth. They've got a small portion of the total addressable market. So this is a business that will likely grow for decades to come. Yeah, it's a great business. I just can't justify paying $3.90 per share for this business when, don't think I'm being too conservative here. Like, these growth rates of 15, 16, 17, 18, 19%, they're not small growth numbers by any means. And yeah, I just can't justify the current stock price, even though it is a great business. Perhaps if you were after a lower rated return, then perhaps you could justify paying the current stock price, but at the moment I'm just going to have to sit on my hands and wait and see if I get a better opportunity moving forward. But guys, I hope you enjoyed this video. A lot of research went into this video here, So I would appreciate if you like it and subscribe. And of course, I'll be coming at you guys with more research over the coming days and weeks. So make sure you stick around for that and have a good one.